Alright, so today I will be teaching you how to allocate the transaction price when a transaction involves multiple products that a company also sells separately. Let's get into it. For our example problem, let's assume that Space Systems sold software to a customer for $155,000. As part of the contract, Space Systems promises to provide free technical support over the next 6 months. Space Systems sells the same software without technical support for $135,000 and a standalone 6-month technical support contract for $45,000. So these products would sell for $180,000 if sold separately. How would you prepare Space's journal entry to record the sale of the software? First off, let's put cash as the first account in the journal entry and then $155,000 as the debit, since this was the transaction price Space Systems received. Next, we have to find the percentage of the total standalone price that each individual item is. To find this, first divide $135,000 by $180,000. This comes out to 0.75 or 75%. Next, we need to multiply $155,000 times the 75% to proportionally allocate the sales price to the software obligation. This comes out to $116,250 being allocated to sales revenue, so we can credit sales revenue for $116,250. So put sales revenue as the next account in the journal entry, and then put $116,250 as the credit for that account. Next, we need to divide $45,000 by $180,000. This comes out to 0.25 or 25%. Then we must multiply $155,000 by the 25% to proportionally allocate the sales price to the free technical support obligation. This comes out to $38,750 being allocated to deferred revenue, so we can credit this account for $38,750. So put deferred revenue as the next account in the journal entry, and then credit it for $38,750. The technical support is deferred revenue because the support happens over a 6-month period and not right when the sale happens. So now we have recorded the journal entry for the sale of the software, successfully allocating the transaction price. If you want to make sure that you have all the right numbers and that your debit and credits are balanced, all you need to do is do sum and then sum sales and deferred revenue. It comes out to $155,000, so you know the journal entry is balanced and that you correctly calculated the allocation prices. Now I'm going to give you another example and let you work through it before explaining it. For this example, let's assume that Video Planet sells a big screen TV package consisting of a 60-inch plasma TV, a universal remote, and an on-site installation by VEP staff. Let's fix that real fast. On-site. VP concludes that the TV remote and installation service are separate performance obligations. VP sells the 60-inch TV separately for $1,700, sells the remote separately for $100, and offers the installation service for $200. The entire package sells for $1,900 when bundled together. Your job is to find how much revenue would be allocated to the TV, the remote, and the installation service. So, to set it up by yourself, I would do a little something like this to have it organized. You got item description in one column and then allocated revenue in the other column. Under the item description column, have the 3 different products/services in the package. So have TV as the first one, the universal remote as the second one, and finally, installation service as the last thing under the column. From here, you should be able to figure it out, so I would recommend pausing the video and trying it yourself. If you don't get it, that's okay. After all, that is what practice is for. Alright, so now that you have paused the video and completed it, let's review. First off, you should have added all the individual prices together to find out what the total is when they are all sold separately. So that would be $1,700 plus $100 plus $200. This comes out to $2,000 for all three items when sold separately. From there, we need to divide each individual item price by this new total. So first, do $1,700 for the TV divided by $2,000. This comes out to 0.85 or 85% if you want to put it in percentage. Now, back in the second column chart, we can multiply this 85% by the package price, which would be 85% times $1,900, which comes out to $1,615. Now, let's do the next two. For the remote, divide $100 by $2,000, which comes out to 0.05 or 5%. Then multiply $1,900 by 5%, which comes out to $95 allocated to the universal remote. And then finally, for the installation service, do $200 divided by $2,000, which comes out to 0.1 or 10%. Then multiply $1,900 by 10%, which comes out to $190 being allocated to the installation service from the total of the package price. Great job! Now that you've found all the allocated prices, let's add them together to make sure they all add up to $1,900. So just do equals sum in Excel, then sum all three prices, and that comes out to $1,900, meaning that you've successfully done the calculations and have allocated the prices correctly to each product. If you haven't done this, that's okay. Just go back, redo your calculations, and check again. Congratulations! Now you know how to successfully allocate the prices of a transaction when there are multiple performance obligations. If you ever need to review this concept, feel free to use this video as a reminder. Other than that, thank you all for watching and have a wonderful day.